And let me start off by welcoming all of you to this, I think it's our first public event for 2019. And what better topic to inaugurate it with than to look at the prospects for the developing world for this year. And that's what we're going to be focusing on today. And I want to thank you for taking the time to join us. And I also want to welcome those of you who are joining us online. I suspect there's perhaps a larger percentage of people who've decided to join in online today if they've had difficulty working their way out after the snowstorm. So welcome to all of you. What we would like to do today is to start off with Ehan Kos, who's the Director of Development Prospects Group at the World Bank, and give us a sort of 20-minute presentation based on the flagship report they have just produced, and of which Ehan has just given me a not yet autographed copy. But I encourage you all to get a copy of it. So it's called Darkening Skies. He's going to tell us why is it called Darkening Skies. And after Ehan does that, then we have a terrific panel who are going to give us their perspectives on what Ehan has said and also on different regions of the world. And I was thinking, as we get to that we have most regions of the world covered, and I was thinking, we don't really have anybody who's going to talk about the Middle East, but I do see some very knowledgeable people sitting in the audience about the Middle East, and in due course, I'm sure they may also want to share their perspective. So we'll open it up, get all of you, if you have questions, to raise them. So before we get to the panel, though, and I'll introduce them when I ask them to join us on the podium, I would like to turn it over to Ehan and encourage him to come first.
I'm waiting for the presentation. Okay. Darkening skies are here. So good morning, everyone. And let me say good morning to those watching online. And let me thank Masood for inviting us again and to present the World Bank flagship report, Global Economic Prospects, and actually putting together a wonderful session from representatives from the IMF and the UN. This is the first time I am attending actually a session on the global economy with these institutions represented. So we just released the report. The title is Darkening Skies, and I will explain why. The report has the usual global and regional outlooks. In addition to that, there are some analytical chapters. I invite all of you to look at it. One is on informality. Another one is on inflation prospects in emerging market and developing economies. We have another piece on poverty, impact of food price shocks, and finally another piece on debt in low-income countries. A number of scholars worked on this issue at the Center for Global Development. So I am going to focus on 4 questions very quickly. The first question is, how is the health of the global economy? The answer is that global growth remains robust, but we lost the momentum we had at the beginning of 2017. Now, when we look at the multiple activity indicators, high-frequency indicators, they all point to a clear slowdown. What are the challenges of informality in emerging market developing economies? This is our anchor chapter, analytical chapter. And there, what we documented, informality is widespread in emerging market developing economies. And it is a symptom of underdevelopment. It's associated with all these, adverse development outcomes. And it's not something you can easily resolve. You need to have a comprehensive strategy, policy strategy to overcome informality. And what are the major risks confronting global economy? There are two important risks. The first risk in 2019 is escalation of financial stress. And the second thing is the likelihood of, more protectionism, especially between two major economies. And finally, what policies could help there, the policymakers need to be proactive in terms of cyclical policies as well as structural policies. In an environment, growth is slowing and risks are rising. So throughout the presentation, I'm going to use this acronym EMDEs that refers to emerging market and developing economies. So let me start with the first question. How is the health of the global economy? Now, when you think about the external environment facing emerging market and developing economies, there are three important observations. Number one, what is going on in advanced economies? The answer is that those economies are going to slow in 2019, and they are going to slow further in 2020. That's going to happen in the United States, that's going to happen in the Euro area and Japan. And this slowdown will, of course, have an impact on global demand for goods and basically services produced by emerging market and developing economies. I mentioned some high-frequency indicators. We focus on the manufacturing activity. We focus on trade numbers, and of course we look at the different components of purchasing managers' indices, including export orders, a kind of leading indicator. When you look at these variables, what you see, all of these variables picked up significantly since mid-2016. When you come to basically beginning of 2018, they basically all lost momentum. You here in the middle panel, you see the manufacturing PMI, a clear loss of momentum there. But the more importantly, export orders now indicating a contraction down the road. And the latest numbers we got this week from Asia, basically in major economies, exports are contracting in East Asia. Now, the other important variable to think about is oil prices. Oil prices actually declined quite a bit in the second half of last year, but at the end, ended up basically having an increase relative to 2017. Dynamics remain quite volatile in oil markets. There are questions about the supply side, whether the OPEC and non-OPEC economies can basically control the supply to the extent to push the price up. But there are also serious pressures on the demand side because of slowing global growth. Let me turn to what happened in 2018. We need to understand that financial stress episode that started in April 2018. We saw the ramifications of that episode in some economies more than the others. Argentina and Turkey come to mind. The important point here is that this episode was a more severe episode than the taper tantrum episode these economies basically experienced in 2013. Then what happened is that when you look at the same time period relative to beginning of the taper tantrum episode and this episode, what you see actually emerging market developing economic currencies depreciated more, portfolio flows declined more, and spreads increased more in the case of the global financial stress episode in 2018. So what is important here is that markets are looking at countries with vulnerabilities. Those countries with current account deficits relative to those with current account surpluses ended up having much larger depreciations last year. And countries that affected the most during this financial stress episode, adversely affected the most, are those countries. They tend to have larger current account deficits and tend to have larger short-term external debt. And these countries are the ones they will likely to face pressures as we move into 2019, and these risks in terms of financial stress and trade tensions become intensified. Let me quickly talk about growth forecast. our headline growth number has not changed much. We are thinking that growth is going to decline to 2.9% in 2019 relative to 3% in 2018, and it will go down next year a bit more to 2.8%. We downgraded global growth forecast for this year and next year, primarily because of the downgrades in emerging market developing economies. Advanced economies we expect to continue slowing down this year and the next year. Especially next year, we will see a sharper slowdown in advanced economies, primarily because of the slowdown in the United States as the fiscal stimulus wanes. In emerging market developing economies, we had a number of countries growth forecasts downgraded. So at the end, we ended up a significant downgrade for this year and for 2019 by about 0.5 percentage point. So there were a number of countries disappointed in terms of their growth performance. So that ended up basically growth stalling in emerging market developing economies. A number of commodity exporting economies faced challenges, and we downgraded the forecast. And a number of commodity importing economies also were subject to downgrades because of the external environment. When you look at the regions, the first observation is that all regions were subject to growth downgrades except East Asia and South Asia. Except South Asia. In East Asia, we downgraded the China growth forecast just marginally. We expect China to grow 6.2% this year relative to 6.5%. In South Asia, India is going to continue to deliver robust growth driven by domestic demand, and that will keep the region as the fastest growing region. Other than that, in Latin America, Middle East, North Africa, Sub-Saharan Africa, we downgraded the forecast significantly. Let me put these growth numbers in historical context. Now, as you can see, we are expecting, a broad-based slowdown in 2019-20 relative to previous years around the world. Advanced economies will see lower growth, and emerging market developing economies growth pretty much is going to stall around 4.2%. Now, when you think about the growth performance of these economies over the past 30 years, the global growth we have in 2019-20 is pretty much equal to the average growth of the past 30 years. So if our forecasts are correct, basically we will see a kind of neither here nor there growth, but the average growth. Advanced economies, of course, have these challenges. They will deliver slightly lower growth, but emerging market developing economies will expect to deliver average growth they delivered over the past 30 years. If average is what you are happy with, actually, this is not a bad performance. But as I mentioned, the risks are rising. Now, the big issue is that whether these economies are delivering enough per capita income growth. In 2019, we will see weaker growth and wider income gap, especially in commodity exporting regions. Here, what you see is per capita growth in Latin America, Caribbean, Sub-Saharan Africa, Middle East, North Africa, very low, around 1%. In the case of Middle East, North Africa, is close to 0. And when you look at fraction of countries, we think they are going to converge to advanced economy income levels in terms of delivering higher growth per capita than what we observe in advanced economies. There are significant challenges. In the case of MENA, close to 60% of countries are going to deliver growth rates, actually, per capita growth lower than what we see in advanced economies. In LAC, Sub-Saharan Africa, that number is quite significant. So in the aggregate, as much as you think this is okay, when you look at the per capita growth numbers, these are not sufficient for these economies to deliver the type of poverty reduction we would like to see and basically achieve the development objectives. Let me quickly talk about the challenges of informality in emerging market developing economies. It's a very important issue. Why? it is widespread in emerging market developed economies. 1/3 of activity, on average, in emerging market development is informal. These transactions not recorded, even though they are legal. The face of informality is different. Mostly you see informality in Latin America, Caribbean, Europe, Central Asia, and East Asia, and Pacific. Now, when we think about what are the correlates of informality, these are not the drivers of informality. These are not necessarily outcomes of informality. It's not basically a causality relationship. But countries with more informality tend to have lower per capita GDP, tend to have larger agricultural sectors, tend to have less effective governments, and tend to have more difficult business environment in terms of regulations. So informality is a manifestation of underdevelopment. Now, there are other issues associated with informality. When you have large informal sectors, government revenues tend to be lower. When you have large informal sectors, productivity of an economy tends to be lower. Now, we discussed these issues extensively at the global level, and for each region, we look at the dynamics of informality and the challenges separately. There are 6 regions we focus on. So what are the policies to deal with informality? Informality, as I mentioned, differs across countries and regions. You go to Africa, there are some countries, very high informality, 90% of the economy is informal. You go to some middle-income economies, it's difficult to differentiate informal firms from formal firms because there are a lot of formal firms undertaking a lot of informal transactions. So it is important to tailor policies to country-specific circumstances. Now, is it possible to resolve informality pretty quickly? Because some governments think that it's possible, and to increase revenues. The answer is no. Most of the time, those types of programs lead to actually larger informality, not smaller informality. It's necessary to think about a package of complementary policies. You can undertake fiscal reforms, but you also need to think about policies to support vulnerable groups. A big majority of them basically work for informal sector. And ultimately, informality requires a long-term program thinking about long-term development outcomes. Let me quickly turn to the risks confronting the global economy. Now, there are multiple risks. We hear these risks every day, the financial stress and trade tensions out there, and policy uncertainty, geopolitical risks, and down the road, weaker than expected potential growth. Let me focus on the financial stress and trade tensions issue here. Now, the first observation is that when you think about the term premium, what financial markets expect to keep these long-dated bonds, are still quite low. So if we see a stress episode and term premium increase because you have an inflation surprise or Fed increase interest rates faster than what markets expect, you might have a violent market reaction. Why this is an important issue? The first reason is that asset prices, especially in the United States, appear to be stretched relative to where they were prior to the global financial crisis. And you can see what happened over the past 6 weeks, especially equity prices of tech stocks declined quite a bit. These stocks increased around 400% over the past 10 years. Now, there's another important issue, the amount of debt around the world in an environment of likelihood of financial stress. And wherever you look at, that has increased relative to what it used to be prior to global financial crisis. Now, here in the report, we focus on low-income country debt, and there the issue is that you have now more private creditors coming to the market and lending these economies. You have non-Paris Club creditors coming and lending to these economies, increasing the transparency, understanding balance sheets of these low-income countries, and basically making sure that they are resilient enough to changes in financial conditions going to be important in the coming year. Now, trade tensions are, of course, at the center of the debate. Now, when you look at the global imports affected by these new tariffs, in the case of the United States, that's around 12%. This can go up significantly if these proposed tariffs put in place in the context of imports from China. Now, when we think about the trade tensions between the United States and China, we need to remember that these two economies account for 20% of basically global trade, and depending on how you measure it, 40% of global GDP. One major risk we are focusing on in 2019, we know that both US and China are going to deliver slower growth in 2019. The question is that what will happen if both of these economies deliver slower growth than what we expect in 2019? If that happens, and if both at the same time deliver 1 percentage point slower growth, the consequences for global growth are quite significant. This will shape about 1 percentage point growth in world growth. Now, there's a lot of talk about probability, about a coming recession in the United States, and there is a lot of talk about the possibility of global recession. About the possibility of recession in the United States, whichever indicator of recession probability indicator you look at, as much as these numbers climbing up, the likelihood of recession in the United States still quite low relative to the likelihood we saw prior to the past US recessions. In the context of global recession is something quite difficult to, basically trigger. Since 1960, we had only 4 global recessions, 75, 82, 91, and 2008. So the likelihood of that event even smaller than likelihood of a recession in the United States. Not every US recession triggers a global recession, but when the US is in recession, the likelihood of global recession is around 50%. So the bottom line is that this conventional probabilities of recession remain low, but we should be vigilant given the risks we are facing. Now, let me conclude with this question: what policies could help at this point in the cycle? And this is going to be rather generic, but it is critical for policymakers to proactively respond to risks. And that means making sure that they have policy frameworks in place that are able to utilize fiscal, monetary, and financial policies, whatever the risk they are confronting. This is an environment. It's difficult to generate growth driven by external sources. Growth increasingly needs to come from domestic sources. That means it is important to think about cyclical policies, whether there is space there, and then think about, of course, structural reforms. And there, identifying priorities is important, and implementing the reforms important. And there are important global challenges, and those challenges will really require countries working together, not separately, and basically coordinating policies and thinking how to improve multilateral frameworks. We are going through a period of increasing threats to the multilateral entities, and we might end up at a point, actually, we will need more help from those entities to make sure global economy is functioning in the way we would like to see. So let me conclude. I asked 4 questions. Number 1, how is the health of the global economy? Still okay, but the growth is slowing, and there are serious challenges ahead. We talked about informality. It's an important issue, and it will require a comprehensive thinking when you would like to overcome it. There are major risks, and those risks focus on 2 items: the financial stress and trade tensions. And in terms of policies, it's important for policymakers to understand that transitions are always difficult. 10 years of uninterrupted growth in the global economy basically might be coming to an end, in a way that global economy finds its direction to have a slow landing, like the US economy is trying to do. During these transitions, there is a big difference between good policies and bad policies. Policy mistakes will or often trigger the types of slowdowns and recessions with, of course, adverse consequences. Let me stop here with a little bit of advertisement. I invite you all to check our publications, and you can find them on our webpage. But let me stop here. Thank you.
Thank you very much. Come, we can come and sit over here. So let me encourage, excuse me, the other panelists to come and join us. So Ehan gave us a good overview, and while the panelists are sitting down, let me just take a minute to introduce them, and I'll introduce them in the order in which I will ask them to speak. And the first person I'm going to ask to speak is Marie Goold. Marie is the Deputy Director in the Africa Department of the IMF and has worked in a number of departments in the IMF before that. So she can give us a little bit of the perspective on Sub-Saharan Africa, which of particular interest to many people here. And after that, excuse me, I'm going to turn to, excuse me, to Sudhir Shetty. Sudhir has been the chief economist of the East Asia region in the World Bank, and before that has worked in quite a number of different parts of the bank, and is now in the happy state of transition where he is soon to retire from the bank in a month or so. After Sudhir, I'm going to turn to Liliana. Liliana Rojas Suarez is a senior fellow here at CGD, working on not just Latin American economies, but on financial sector issues more broadly, and before that has been in the IDB, in the commercial sector, in Deutsche Bank, in the IMF, and advising a number of other institutions. And finally, I'm really very happy that today we're going to have Don Holland with us. And Don is the chief of the Global Economic Monitoring Unit in DESA, in the UN Department for Economic and Social Affairs. And DESA, of course, in the UN, produced their flagship World Economic Situation and Prospects, which is going to come out next week. And so we thought it's very timely to actually have Don here to take a look at the sort of how the perspective on the global economy, the risks, the vulnerabilities coincide or provide an additional dimension to the discussion we're going to have. So that Don's going to round that off. Then we'll open it up and get your views. So with that, let me turn to Anne-Marie first. Anne-Marie, what was your reaction to Ehan's big picture, but also how do you see within that Africa? And I was really struck by one chart that Ehan had, which was the per capita growth chart. And if you looked at Sub-Saharan Africa, essentially nearly half the countries, per capita incomes are falling behind what's happening in advanced economies rather than catching up. And some of these are, of course, the poorest countries. So a few minutes for you.
Thank you, Masood. And you're just taking the point with which I wanted to start. Overall, I think this is a very good report, and we agree with most of what is being said, but I think, there is maybe for the Sub-Saharan Africa story a bit more context needed than what we had in this presentation. And as you said, the growth is really a key challenge. And I would put it not only the short-term growth, but I would really look at it also, look at it as a medium-term story, because you know that the starting point for most of the countries is very low. At current policies, we in the IMF estimate that growth is going to plateau at about 4%, which would be 1.5% on per capita terms, as similar to what was pointed out. This is overall too low to harness the benefits of convergence and of the demographic dividend. But we have to see that there is some heterogeneity here, and we have a third of the countries, especially the commodity producers, where per capita growth has been negative and is projected to stay in negative territory. So this is not something that we can think of as a long-term sustainable solution. And we have to step back and see what happened before. I mean, this low growth follows on a period of optimism. We had a decade of strong growth that was interrupted by the commodity price shock of 2014. During that period, significant strides were made in social outcomes, but we now have to see that some of those results were achieved against the background of what is now leading to the build-up of macroeconomic imbalances. I mean, the issues that we may not have focused enough on at the time was that most natural resource countries did not build up buffers, but used the money for investments, and not always the most effective investments. Similarly, the easy financial market conditions led to other countries also tapping financial markets with the view to increasing of investment, and again, the efficiency of investment was not always there. What does that leave us now with? I think what we have to focus on now is that there is a possible tension between the unavoidable short-term macroeconomic adjustment and the longer term growth. This is really the most challenging issue for policymakers. A second point of context, and I think Ian went into that in some detail, so let me be short about it, is really the issue of the global, the deeper global integration of sub-Saharan Africa. Over the past decade, trade has diversified to non-traditional trading partners. For most countries now, China and other emerging markets are key trading partners. Financial linkages also. I mean, a good number of African countries are now frontier markets. So as economists, we know the benefits of global integration, and this is it's beneficial for Africa as well, but we have to recognize that spillovers now exist, and that darkening clouds will have more of an impact than, say, in the global financial, in the big recession in 2008, where a big part of Africa's resilience really was due to the fact that there were no financial, very limited financial linkages. So let me now turn to the increased macroeconomic vulnerabilities, and in particular to the issue of debt that require action. As is set out in the report, I mean, debt of Africa on average has increased very much. We're now on average at 50% of GDP. That's a 20% increase over the last 4 or 5 years. And important, in spite of the relatively low interest rate at which these debt was contracted, I mean, about it eats up, debt service eats up about 10% of fiscal revenues, and that's a doubling since 2011. Like this report, we, the IMF, have flagged the debt issue in our flagship reports, but also in individual country reports. Looking at the reasons for the debt build-up, number of factors have contributed. Certainly the delayed adjustment to the commodity price shock in 2014 and the easier market access were key contributing factors. And coming back to the growth challenge, the real challenge now is to ensure that policies to address the debt issue do not create excessive obstacles to sustain strong and inclusive growth in sub-Saharan Africa. This is important also in the context of the Sustainable Development Goals, which have to be the guiding rod of what we want to achieve forward-looking for sub-Saharan Africa. So with this in mind, I would just want to highlight three main issues in policy design. First of all, it has to be recognized that in many countries, significant fiscal adjustment is really unavoidable and should not be delayed. But we have to look at the downside and stability risks from each policy action and designing policies accordingly. So as the report says, focusing on domestic revenue mobilization, broadening the tax base is one very important element in that. The other element is looking at the efficiency of investment. This has been a critical point that I made before, and looking at some of the investment projects that I have seen, this is where there is room for improvement. And it's important that the adjustment, whether it's designed in the context of an IMF program or as homegrown, is really looked in the context of a medium-term plan. A second point that Ian also pointed out, I mean, the debtor landscape, the creditors have changed quite significantly. We have non-traditional creditors, in particular China, and we have a lot of commercial debt. We have collateralized debt. So this puts certainly at risk those countries that are already in debt distress, and there is a good number of those. So there is a challenge in finding a resolution of cases that are already active, such as the Republic of Congo, where the current resolution mechanisms in the context of the Paris Club do not work. And then a final point that I want to emphasize is that you know, the issue that many of the countries in debt distress or close to debt distress are natural resource countries points to the need of looking at improved fiscal frameworks. The fiscal frameworks in place have not led to building up buffers and to sustainable, the ability to have a sustainable budgeting framework. So having fiscal rules that are more adequate is a critical forward-looking element. And then very final point, better tools. Here the IMF and the World Bank are working together on new tools, would point the new debt sustainability framework and efforts to increase transparency of debt. Those are all important, and it is important that countries get the help they need, also through technical assistance. And but there has been technical assistance here before. I think we need to also step back and look at the traction of this assistance to really put countries in a better situation going forward. So with this, thank you very much, and I look forward to the discussion.
Thank you very much, Anne-Marie. So I think the issue of debt in Africa and in low-income countries comes up now, you know, at every other session that we have here. So no matter what topic we start from now, debt is becoming a bigger topic, and something that I hope we can come back to and talk a bit more about. The other point, which I was struck by looking at the numbers in your report, and maybe you have something you could say on that, is that the three big economies in sub-Saharan Africa, so Nigeria, South Africa, and Angola, are really holding back the aggregate numbers. If you look at the numbers for sub-Saharan Africa, excluding these three economies, you actually see much better performance in a whole range of countries. And to what extent is there just an impact in terms of aggregate numbers, but as opposed to also a spillover from these economies into the others? So are they holding back only the numbers, or are they also holding back the economic outlook in other countries? What's your thoughts on
No, I
that?
think you're making a very important point. There is quite some heterogeneity, and some countries, especially in East and West Africa, are still growing very fast. But those are not number-wise. I mean, the big countries. Your question is an important one. I mean, are there spillovers from the big ones to the, could Africa essentially create a self-sustaining growth if those countries were doing better? We've done some research on that in the IMF, and we have seen that trade, intra-African trade, has increased quite substantially, especially outward trade from South Africa, and that South Africa has really suffered quite a bit from Nigeria's slowdown. Similarly, the country around Nigeria, and there it's often more informal than formal trade, but very, very closely integrated with it. Angola is somewhat less integrated with the rest of it, but Nigeria with its more diversified economy, South Africa with its more advanced export products clearly could be, if they were doing better, would be locomotives for Africa.
Good. So maybe we'll come back to more about Africa, but I want to move to Sudhir. And so it's a little bit of a, you see East Asia is going to slow down to 6%. And so, you sort of think, well, this is a different discussion, right? So we're slowing down to 6%. But the vulnerabilities are still there. And maybe we'll give your perspective in East Asia before we have a discussion on it.
Okay. Thanks, Masood, and thank you for inviting me to be part of this panel. But let me just first begin by talking just very briefly about the global economic prospects and the main messages that Ayhan put out. But and one of the things I think that Ayhan and his team have done very well in the past couple of years is that really it's sort of the narrative has built up in the JEP. And I think if you look at how this one, the darkening clouds theme, picks up very well on their theme of a year ago, which was a broad-based upturn when everyone was cheering at the beginning of 2017 that things, at the beginning of 2018 that things were going great. And I think Ayhan and his colleagues sort of asked a question, but for how long? And I think that's picked up very nicely in this report by pointing to some of these risks and headwinds that lie ahead. So let me turn to East Asia, and I don't want to talk very much about the outlook because the good news is, since the World Bank is a perfectly functioning bureaucracy, we collaborate very well across boundaries, and so my colleagues in East Asia work very closely with Ayhan and his team. So we agree entirely on the numbers. China is going to grow precisely at 6.2% in the near term. But so I want to focus really more on your question, Masood, about the risks, and then most importantly, I think on the policy aspect, because obviously the global economic prospect, since it covers a range of countries ranging all over from the smaller countries in sub-Saharan Africa and the Pacific to China and the advanced economies, is of necessity generic in its policy recommendations. So we can be, now although East Asia and Pacific, I like to say, has at the one extreme, and just developing East Asia and Pacific, has at the one extreme China and at the other extreme Tuvalu. So that's a pretty large canvas there, but we can be a bit more specific. So first, on the risks, and I think the way I read the JEP, there are three things that Ayhan and his colleagues have highlighted. One is the risk of trade tensions and slowing trade growth. The second is the risk of financial stress. And the third is the volatility in commodity prices. Now, each of these is clearly going to affect different groups of countries in East Asia and Pacific differently. The commodity thing, a little bit less, because compared to, say, Sub-Saharan Africa, the region tends to be largely a region of commodity importers, with the exception, of course, of Indonesia, Malaysia, and smaller countries like Papua New Guinea and Laos to a certain extent. But the other two, the trade tensions and the financial stress, are obviously really important, because this is the most outward-oriented region in the world in terms of trade, in terms of investment. That's what its success has been built on. So drilling down on those, so in a sense, as Masood said, policymakers in this region have, compared to their colleagues, say, in Sub-Saharan Africa, and certainly compared to their colleagues in Latin America, which I'm sure Liliana is going to elaborate on in a moment, have a happier problem, right? Which is they're still going to grow at 6%. That's the base case. The kind of reduction in the projection that Ayhan indicated for East Asia is relatively small, and it's entirely driven by a small adjustment, a downward adjustment in China. But nevertheless, the problem in East Asia is they've gotten used to robust rates of growth, right? That's the deal in East Asia. You know, even 5% is looked at somewhat, you know, if Indonesia isn't happy with 5%, because there's countries growing at 6, 7, 8% around them. So the question then is how do they manage these risks while sustaining growth over the long term? And you know, the way we sort of think about it, I would suggest a kind of a four-pronged strategy. The first is to build resilience and enhance preparedness. Because I think, as Ayhan brought out, the likelihood of a major shock, we don't know where it's going to come from, we don't know when it's going to come, but the likelihood is much larger now than it was a year ago. And so if I were advising a policymaker in East Asia, I would say, be prepared. There's a lot of uncertainty out there, and this was why every 6 months we bring out sort of a very poor cousin to the global economic prospects. It's called the East Asia Pacific Economic Update. And the last one, which we brought out just before the annual meetings in October, was called Navigating Uncertainty. And that's really the key, because there's a lot of uncertainty. We don't know when the shock will come, but they've got to be prepared. And the preparedness for most East Asian economies is around rising levels of debt, and it's not the kind of debt you see in Sub-Saharan Africa. A lot of this is corporate debt, a lot of this is household debt. China, of course, leads the pack, but it's not just China. You see it in other economies as well. Malaysia, for instance, you see high rates of credit growth. So dealing with this rising leverage. So it's about macroprudential regulation. It's about improving financial sector regulation and supervision. It's about, in most of these economies, continuing to rely on flexible exchange rates to absorb external shocks. So, and this is something most of them have done relatively well, which is one of the reasons why growth has held up as well as it has. But it's something they need to continue to do, and the trade-offs are likely to get greater going forward. But there's also an important implication for fiscal frameworks. And that is going to be the more difficult thing for many of these economies, because when you think about, you know, Indonesia, this is a G20 member, and it raises all of 14% of GDP in revenues. You can't, and those of you that have been to Jakarta realize that, yeah, they have huge infrastructure needs. They know they have huge infrastructure needs. It's really hard to meet those infrastructure needs unless you keep muttering PPP until you're blue in the face. It's really hard to meet those if you generate 14% or 15% of GDP in revenue. So there's a major issue there. There's a major agenda there in terms of raising revenues over the medium term. So that's sort of the, you know, the maintaining macro stability, enhancing resilience, enhancing preparedness. But there's a second aspect, which is, as I said before, this is the most outward-oriented of regions. This is the region where we can show as clearly as we can anywhere that openness works. Openness works for growth. Openness works for poverty reduction. Openness works for raising living standards. And yet they're faced now with a world in which people are turning inwards. Advanced economies are turning inwards. There's trade tensions between the two largest economies in the world. So our advice to East Asia would be, this is the time for East Asia to step up and redouble its commitment to an open trade and investment framework. It means doing more. It means playing a bigger role, not hiding, not saying this is someone else's business. And a big part of that in East Asia is about regional integration. ASEAN talks a good game. It could play a better game. And Indonesia obviously is critical there, but so are the others. And it's in this respect that it's good news that the TPP didn't die. It's a good news that the remaining members of TPP decided to sign a deal that would retain many of the elements, not all of the elements of TPP, and that included the developing countries that were part of TPP, Vietnam and Malaysia in particular. So there's an agenda there. There's lots more to be done on trade integration in services. East Asia lags. It's done very well on goods. It's not done so well on services. This is increasingly important in a world in which there's much greater fuzziness between goods and services. So there's an agenda in terms of East Asia playing much more of a leading role on integration. Third, going to the point that Ayhan made about potential growth or potential growth falling. There's an agenda for East Asia to promote growth, to its medium-term growth prospects. So despite the fact that there's been lots of regulatory reform, there's been lots of reform in terms of trade, there are still aspects in most East Asian economies where there are barriers to competition. And one of the big issues in many of these economies is the lack of a level playing field between state-owned enterprises and private enterprises. Vietnam is an example. China, of course, remains an example. So there are things to be done there. There are things to be done in terms of leveling the playing field between large and small firms, which also goes to the point about informality that's picked up in the JEP. So there's an agenda there. And then finally, there's an agenda around ensuring that growth continues to raise living standards for all. So East Asia is, of course, the great success story. We're sitting here in a conference room named after one of the authors of the East Asian Miracle. Yes, it was a miracle. It has raised living standards and reduced poverty. But there are increasing questions about mobility, about security. The fact that East Asia has done so well on poverty hides the fact that there are still about 600 million people in East Asia that live below what we would refer to as a level of, that are vulnerable to shocks. If you think of that as being about $5.50 per day in 2011 PPP terms. So there's an agenda around security, there's an agenda around promoting mobility. This has to do with things like education, particularly early childhood, including early childhood development. It has to do with better safety nets. It has to do with other ways of promoting resilience. So let me stop there.
Thank you very much, Sudhir. So clearly an agenda, even though the aggregate numbers look pretty good. Liliana, so the aggregate numbers don't look pretty good in Latin America, actually, and haven't looked good for a couple of years now. So yeah. I want to get a little bit your sense of, is this some equilibrium we're in?
Well, for Latin America, it seems to be over the last decade or so. But let me try to frame the Latin American situation responding three questions. First, which are the most important external factors that are affecting growth and stability in Latin America? The second is how resilient is Latin America to those external shocks? And the third is what policymakers in the region can do. So let me start with the first, which are the most external factors. You know, in Latin America, a large number of countries are commodity exporters. And so in the past, the story has been a China story. Whatever happened in China actually had a huge effect on Latin America, and that was significantly felt, especially in 2014 after the decline in commodity prices. And since then, Latin America slowed down significantly. However, in my view, the IMF's projections about China slowdown have been already internalized. And what I believe that for this year is going to be the main story of factors affecting Latin America is what happens in the United States. Latin America is going to be a United States story. And basically, if we are going to look at variables, one would be looking at the behavior of the Fed, the appreciation of the US dollar, and Trump-led protectionist world and nationalistic stance. And the reason is because those three factors are the ones that are maintaining the large volatility that we are observing in in the financial sector prices, and also are decreasing the appetite of investors for emerging market assets, including those of Latin America, because Latin America is a large supplier of those international assets. And so let me give you some facts, right? Why issues of, and here we come again to the issue of debt. Why in many, in the world, actually, people are talking much more about the issues of corporate debt, which is also a problem in Latin America. The truth is that government debt has also increased significantly in the region. It's not just corporate debt, it's also government debt. And since 2010 to date, all debt, corporate and public, has doubled in Latin America as a proportion of GDP, with, of course, significant difference between countries, and also about, for example, if you compare Argentina, it's all public debt. If you look at Chile, it's all corporate debt, okay? So there's a huge variety. But there is other indicators that are worrisome. For example, with the exception of countries like Mexico and Peru, total external debt service, meaning the amortization and interest payments, so the flow of payments that a country have to service as a ratio of GDP, has increased significantly, and in many countries have reached 16 to 18%. Now, that compares with Turkey at 20%. So Latin America, in that regard, I mean, many people don't focus so much on debt issues in Latin America, but they certainly are. So in that environment, how resilient is Latin America? Because one thing is what are the shocks coming from the external environment, the other one is, okay, how can you respond to them? Well, clearly, that answer depends on how large are the external needs of the countries. The second, which are the share of debt denominated in US dollar that is not hedged. And finally, the growth dynamics, because in a situation, in an environment when interest rates start to increase, those are not permissive, or they are actually constrained to economic growth if you don't have domestic sources of growth. So again, data provides some insight for answering this question. You know, when you put together all the largest or the most traded, I would say, financially traded emerging markets, Latin America stands out because of its persistent current account deficit. Actually, Turkey and Argentina, not surprising, are among the emerging markets the ones with the largest external financial needs, with Argentina, of course, being covered by the IMF program at this stance. But with some distance, even countries like Chile and Colombia maintain very high ratios. So financing needs in the region are very high. And this is, again, not surprising because the story has been repeated many times. In many countries, the mirror image of these external financing needs have been or are large fiscal deficits, which means that the region does not have fiscal space at this point in time. And this is very important. So first, big constraint, there is no fiscal space if a shock is going to hit the region. When we talk about the ratio of debt denominated in US dollars, well, this is a very hard number to know about because we don't know. Really, there's no sufficient information about how much of the debt is actually hedged. If we just look at what are the countries that have the highest proportions of debt denominated in US dollars, those are Mexico, Argentina, and Brazil. But again, we don't have sufficient information about hedging. And from my perspective, that could be a call to the multilateral institutions to get better information on hedging, because only then we could know how much is the vulnerability. Now, on growth dynamics, that is the worst message. Last year, Aya, you were here making a presentation, and what you said, among many other things, of course, is that per capita potential growth in Latin America was below the average for developing countries. So Latin America potential growth is below the average of developing countries and is projected to decline. So it's not only the lowest among the regions, but it's also going down. Okay, so it doesn't have strong growth dynamics. So now, I've been talking a lot about vulnerabilities, but of course I have to talk about the strengths. What is one of the most important strengths in the region, which is actually enviable for so many others, is that central bank policies have been very adequate, keeping inflation low, including the avoidance of financial crisis. I mean, there has not been banking crisis, not even with huge recession in Brazil, not even with the problems in Argentina. You have not seen a banking crisis. This is unique in the history of Latin America because I wrote a book called Banking Crisis in Latin America because it was so easy to report that there were so many crises. And of course, the other huge achievement is that the ratio of international reserves over short-term debt is very large. The region has self-protected itself like crazy in terms of accumulation of reserves. I'm not going to talk about flexible exchange rates because, yes, it's true they are very good as a buffer, but they are not panacea. And there are many circumstances under which they actually won't help. So, I mean, perhaps with questions. So finally, to end this initial presentation, what can policymakers in the region do? Well, the challenge is very clear, right? Is how to manage the bumpy and protracted transition from abundant global liquidity, where fundamentals were not important, right? When you have global abundant liquidity, the financial sector finances everything, regardless of fundamentals. And that's why many countries are in the situation they are now. Well, managing that transition where fundamentals could afford to take a back seat to a world where strong fundamentals becomes the name of the game. So that is the challenge. Now, of course, we know that what the solution is. I mean, in terms of, and Aya and everybody is going to talk about the need for the structural reforms that are needed in the region and in all the regions. In Latin America, two stands out, labor reform and judicial reform. I mean, but I want to make an emphasis on now, right? So now, I would advance two recommendations. The first one is to be practical. Recognizing, of course, that reforms need to be placed, there is a survey in Latin America called Latinobarometro. It measures people's perceptions. And for the first time since the Latinobarometro started its survey, the region confidence on institutions, including the judiciary and Congress, is at the lowest point since the mid-90s. Okay? So it is very hard in the region to pass reforms. And especially, you can imagine, in an environment where the external forces are pushing actually to a more slowdown of economic activity. So, in my view, the urgent need is to protect those institutions that could prove very highly useful and that work now. And then I come back now to the central banks. Why to the central banks? Because if you remember every past crisis, including in the United States, who have been the heroes that have actually been, and Europe, that had actually led the economies out of financial crisis, have been the central banks. And the central banks, many, not all of them, but most central banks in Latin America are very healthy. So protect the independence of those institutions, which can do and are able to do right now countercyclical and macroprudential monetary policies. And the second recommendation is learn from recent experience. And for this, let me advance example or the contrast between Argentina and Brazil. Argentina went very gradual in its fiscal adjustment because of political constraint. So gradual that debt kept accumulation to the level when there was a crisis. Brazil is just starting a new administration. Leaving aside all the problems that we could have with Mr. Bolsonaro about his policy stance about the world, there is something that Brazil has to do. And it's not to be so gradual in the fiscal adjustment, because the lesson shows from Argentina that such gradualism, when there is no so much external financial in the world, doesn't work very much. So I'll stop there now.
Okay, thank you very much, Liliana. So Tom, you kind of had these different perspectives, and it would be great to get your take on the world at large, but also on any particular issues that you think we need to be thinking harder about.
Okay, thank you very much, and thank you to everybody for setting the stage so nicely. The UN's main economic report will be coming out next week. The main trajectory for the world economy will echo very much the presentation from Ayhan at the beginning. We saw the world economic growth coming to a peak towards the beginning of 2018 and has been gradually moderating over the course of the year that follows. Our forecast in terms of specifics of numbers are slightly more optimistic than those of the World Bank, but I would say heavily that is very much predicated on the fact that we are assuming that China and the United States will find some common ground in their negotiations over the next couple of months, and that there will be no further rise in import tariffs. We will also heavily stress, as everyone has already stressed, the risks around the forecast, risks including further escalation of trade tensions, which could slow growth quite significantly from what we're currently expecting. Risks in the form of the financial fragilities, high levels of debt, which mean that any sort of shock that were to hit would have a bigger impact than it would if debt levels were lower, especially countries that hold high levels of foreign currency debt. If their exchange rates plummet, suddenly they're met with interest burdens that are much higher than they'd anticipated. I would add two additional sort of risks that we think are important, and these first was alluded to in some of the presentations. The first being a waning support for multilateral approaches to global policy making in general. We've seen that in terms of trade policy. We've seen that in terms of international development finance. We've seen that in terms of combating climate change policies. Now, there's two things. So that is, to some extent, that's a long-term issue, but it's also a short-term issue. One thing that I would highlight is that what it does, and as is repeatedly stressed, the likelihood of a major shock to the world economy is higher now than it was a year ago. What it does is it puts some doubt on whether we have the collective and collaborative will to put forward a concerted, a coordinated effort to combat any major shocks that were to come and hit the world economy in the next year or so. So that's one concern we have. And the second is that a broader withdrawal from multilateral or collaborative, coordinated policy making, the costs of that are likely to fall most heavily on small developing countries. So they lose out in terms of trade policy. In a bilateral trade agreement, it's almost always the case that the larger economy, the more heavyweight, will have the better end of the deal. We see that in terms of many countries, any delays or declines in international development finance would have a huge impact on many developing countries. And we also see that in collective efforts towards combating climate change. And that brings me to my second risk, climate risks. Climate risks are still viewed as a long-term problem, but they are actually a short-term risk as well. And the World Bank has a very nice section in the report on the impact of climate risks on food price inflation and how that can impact poverty. I think we can go even beyond that. The human costs of weather-related shocks fall very much most heavily on low-income countries or on lower middle-income countries. Small island developing states are particularly vulnerable to the shocks. These small island states are among the smallest emitters of the global greenhouse gases, which are accelerating the process of climate change. So this is a global issue that needs to be collectively addressed through multilateral approaches. So the two risks that I highlight, I think, are highly connected. I would just raise one final point, drawing on the point that Anne-Marie was making on Africa. Growth, per capita growth, is not going to be fast enough to see significant convergence or any convergence in a large number of countries. I would also say that it's not just not going to be fast enough, it's not going to be nearly fast enough. If we're looking at, we have the 2030 Agenda for Sustainable Development sets out a development program which all of the United Nations member states have signed up to. Just one of those targets is to eradicate extreme poverty by 2030. Growth rates of 4 or 5% per annum in Africa and marginal improvements in levels of inequality of the rates that we've seen in the last decade or so are not nearly enough to get us towards that goal. At that rate, we would still see poverty levels of 30% in Africa by 2030. So we need to see growth rates going up to double-digit levels. We need to see inequality levels plummeting, halving by 2030 if we're going to come close to achieving that sort of very, very ambitious target. So that just sort of sets out the scale of the challenges that we face ahead.
Thank you. Thank you very much, Dawn. So we've got about 15 minutes or so, and I'd like to really open it up now and encourage people to ask questions or raise points. And let's start off with Sanjeev in the first row here.
Thank you. This was a very interesting discussion. So I have a couple of questions which are some are broad and some are a bit specific. So Anne's presentation was quite comprehensive. So there, and also wanted to pick up what Anne-Marie said about Africa. So what we see is that in Africa we have projected 1.5% per capita growth going forward. But roughly half the countries in Africa are fragile states. But there was no mention in the discussion as to what the strategy ought to be for these countries to be able to stimulate growth in these countries. So I think one should not overlook this group of countries which are pretty significant in Africa. And so that's, I think, one point that I would like to raise. And the other one is, Ian's presentation talked about the informality having come down from 40% to 30%. But perhaps the chapter has the details, and I haven't seen the chapter, but what are the reasons why the informality came back? It came down. Is there anything that we can learn going forward which will help us to deal with this issue? Was it growth only? Was it some other institutional developments? And this, I would also like to see to what extent new technology can make a difference. If you are going to have financial integration by, like in India, by opening accounts, to what extent that would reduce informality? What would that do? How would the introduction of new forms of taxation, which tend to get a lot of information, improve compliance and informality across countries? I think that is something which is important for countries going forward. And finally, there was across different presentations discussion about need to build up buffers, external or fiscal. Yes, that is true. But to what extent this is possible with electoral cycles that we face? You know, in a number of countries, you're not going to have governments agreeing to generate surpluses in the face of elections. They need more money. And so in fact, in my view, the evidence that is there, when the elections are close, the wage bill goes up by about 1 percentage point of GDP. Something happens to capital spending. So there are a lot of things which change. And that makes all these things very difficult.
Thank you very much, Sanjeev. So I have Benedicte in the back there, and then I'll come to
I would like to ask some questions about the risks in sub-Saharan Africa. And one pertains to the issue that Liliana has mentioned in Latin America, namely the independence, the importance of resilience and independence of central banks for the progress that has been made also on the inflation front and so forth. What is the status currently in sub-Saharan Africa on independence of banks? I've seen a couple of central bank governors having speeches recently about the importance of this particular issue. And so what is the status? The other issue is one on the integration of African banks. The Pan-African banks that have increased in importance with the decline in the traditional British and French banks, and which of course has all the potential positive development in terms of promoting financing, trade, and so forth, and might be behind some of the integration in trade that was mentioned in this presentation. Now, this comes, of course, as a two-edged sword that it's positive, but it also needs to be managed by the supervisory bodies. What is the status on that particular issue?
Thank you. And then let's take Stan here. I'll take two more after that and then come back to the panel. Yeah.
By all the economics I was taught, the world should be suffering from hyperinflation now. We have more debt than we've ever had, particularly government debt. Negative interest rates. But in all the developed countries, there is no inflation. Why not?
All right. And then the gentleman right in the middle in the back here. Yep, that's it. It's a good thing you just wrote a book about this.
Thanks. I think, Mr. Cozy, you mentioned in your presentation that I think the way I interpret it was that donor countries need to be careful about giving traditional foreign assistance to places where there's high informality. Did I get that right? And if so, how would major donor country policymakers think through that?
Okay, and let me take I think we're going to run out of time otherwise, so I'll just take two more if I can. One here, and then there was...
Thank you very much. I'd like to focus on fiscal stimulus. In publication, it's mentioned that one of the major drivers of the economic growth, especially in advanced countries, is fiscal stimulus. And it's well known that in the long run, fiscal activities, fiscal expansions creates negative impacts on quality of institutions and adds more space for informal economy. And my question is about what's your evaluations regarding the using fiscal stimulus as a support of the economic growth? Thanks.
Thank you. There's a lady in the third here, and then one in the back, and then we'll close out with that gentleman.
Thank you. This is a question for Arjan and Anne-Marie. Are you modeling climate risks already in your calculations? Thanks.
Thank you. And the lady in the back there.
I wanted to ask about rule of law and governance and about the legitimacy of governments as it impacts formalizing economies, if that's a concern for any of the panelists, which I didn't really hear in the main presentation. And a related question about decentralized governments, and if you see specific challenges or risks coming from the highly decentralized governments. I'm thinking, for example, Pakistan and Indonesia, and if this is impacting some of the legitimacy and formalization concerns as well.
Thank you. And then there was a gentleman over there. That'll close it out. Yeah.
Hi, thank you all. I wanted to ask kind of twofold question. I think each of you talked about external debts and the buildup across all regions of the developing world, and then a few of you have talked about multilateralism as well. And I think as the HIPC initiative comes to a close, whether or not you see multilateral appetite to recommitting to some sort of external debt reduction process and the upside risk associated with that for a lot of the developing economies.
Thank you very much. Okay, so we have quite a long list of questions, which gives you all some flexibility in which ones you want to pick up on now and which you pick up bilaterally afterwards. So I'm going to actually do this in reverse order, ending with Ehan. So let me start with you, Don.
Thank you very much. So lots of interesting questions. I think I'll make 2 points that I think will touch on several of the issues that were raised. The first is managing natural resource wealth. A lot of countries, a lot of commodity-dependent countries are those that have been lagging behind, have been not converging or deconverging over the last couple of decades. They are home to vast natural resource wealth, which has potential, huge development potential, but it's the management of those resources that is so vital. And that ties into countercyclical fiscal policies. That ties into the point that was raised on governance. That ties into where do we find the finance for all the investment needs that exist. This is politically extremely difficult to do, to make changes to existing systems, but it's absolutely, I think, essential to readjust the status quo so that those resources are being used for the good of the society at large, rather than going to very small interest groups or, in many cases, going abroad to foreign companies. Renegotiating contracts, setting up international organizations can assist by advising on contract negotiation, is essential to set up and to ensure that there are strong institutions that keep these in place, to increase the transparency, and to develop a countercyclical policies that where the resources, the returns from investments are not just channeled back into expanding for more extractive purposes, but are actually channeled into investing in the productive capacities of the economy, so into productive industries and also into the human capital, the education, into the health system, into rural infrastructure, all infrastructure, in order to ensure that these returns are being used for longer-term benefits rather than short-term gains to a narrow interest group. And just one comment on do we have the appetite for further debt relief? I think this is one of the big risks that the withdrawal from multilateralism poses, is that there may not be the appetite for such when it is desperately needed.
Thank you. Liliana.
Yes, let me start with Sanjeev's question. Coming from a region where elections in the major countries actually took place, including in Mexico and Brazil, you're absolutely right. It's extremely hard to build buffers, especially fiscal buffers, in around the time of elections. But what I wanted to really add is that it doesn't end there. What is happening, and this is beyond Latin America, is that there is an increasing polarization because of the elections, because of the dramatic ways in which elections are taking place. And there is a huge divide between Congress and the executive. So building buffers have become very difficult around the world, but it's beyond the elections. It's pre-election, during elections, and beyond the election, which relates me to the question on the fiscal stimulus. Yes, of course, fiscal stimulus can help growth, and that's related to the question of why to build fiscal buffers, actually to use them, to be able to use them at the time of problems. But what has been really happening in the many developing countries and emerging markets is that good fiscal helps growth, and then when the problem is resolved, you remove the fiscal stimulus. What has been actually happening is that fiscal deficit has become persistent in many countries, and in those cases, rather than being a solution, it becomes a problem, because you need to finance those fiscal deficits, and how do you do it? With debt. Or a creation of money. And finally, to the question of why inflation is low, so low, it's a very simple answer. It's a supply and demand answer. It is true that there is huge liquidity in the world, but there has also been huge demand for that liquidity in the world. Actually, the demand for what is called safe assets have been enormous, which is liquid assets. The problem now is that those liquid assets actually came not only from advanced economies, they also came from emerging markets. As the global cycle is turning, those emerging market assets are losing liquidity. And so the danger of inflation to come back, because then if the supply of assets doesn't come down quick enough, the demand could exceed supply, and then you could have inflation.
Okay, Sudhir.
Just quickly, a couple of first on Sanjeev's question about electoral cycles. Well, fortunately for East Asia, large part of it doesn't have to worry about electoral cycles. But leaving that aside, you're right, and as Liliana said, there is always the temptation. But it's actually interesting to see what's happened in Malaysia. So they had an election, and it was actually a remarkable election, right? In the sense that the incumbents, this was an outcome no one predicted ex ante. And the incumbents did a lot of the things you actually mentioned, which is they gave away stuff to public servants. And what is interesting is what happened after that. And one of the things the new government did was it took a hit on growth. One of the reasons Malaysia's growth rate in 2018 fell considerably by over a percentage point relative to 2017 was because they took another look at the public investment program. And they said, look, there's a bunch of this stuff that really we don't think we need. So you're right, there is the cycle, and you've got to worry about what goes on before the election. But what's I think comforting, at least in some parts of East Asia, is that there is actually a recognition that the world economy is in a more dangerous place, and perhaps you need to worry about fiscal restraint more than you did earlier. And in some ways, the way that Indonesia is headed ahead of its election also gives one some confidence. The second is the question on decentralization that someone said. I think the Indonesian experience just shows that it's not a panacea, right? Ex ante, coming out of the 97 crisis, there was this sense that, okay, big problem in Indonesia, too much power in Jakarta. Let's decentralize. Great, they decentralize. One of the things we find is the quality of spending is awful. So there's lots of money being shifted out to areas, and a lot of that money is going to public sector wages with almost no correlation with outcomes on health, outcomes on education. Indonesia has one of the worst PISA scores relative to its income level. So the thinking now in Indonesia is obviously not about reversing decentralization, but how do you make it work in a country as complicated as that? Thank you.
Anne-Marie.
Lots of questions on Sub-Saharan Africa. Let me maybe just focus on two and talk bilaterally afterwards if necessary. I wanted to pick up on the fragile states question that you mentioned, Sanjeev. Of course, there are a good number of fragile states in Africa, and they clearly face the same issues that we have outlined, in addition to especially institutional challenges and uncertainty. So this is a magnified challenge, and some that cannot be dealt with economic policy alone. What we are trying to do is very much to work on the institution building, and you know that you were involved in that yourself, on the institution building aspect through technical assistance to support any kind of political resolution of the fragility issues that emerge. But countries that, and a lot of them are natural resource producers, and on top of fragility, they're facing an even more serious obstacle than others. I would also like to pick up on the question of the independence of central banks that Benedicte mentioned. I think this is something we are particularly worried about. It's related to the issue of fiscal and debt. I mean, we have seen a number of countries resorting to monetary financing, breaking central bank rules, and those are not small countries. I mean, those are the Ghanas and Ugandas of this world. There's also been question of central bank independence, even of the SARB, which is one of the rocks of institutions in sub-Saharan Africa. So emphasize it, like Liliana did, the importance of central banks and what a loss of credibility can mean is really a challenge for us. Let me leave it here.
Thank you very much. Ehan.
Okay. Thank you for all these questions. Let me go over them very quickly. And I'm going to focus on the certain issues. I think some of them were already picked up. Why informality has declined? This is not an easy question to answer, because you would like to say this has happened that ended up driving informality down. Econometrics doesn't let you to do that easily with the kind of the measures we have and the tools we have. What we have seen since 1990, informality has declined in countries that basically delivered higher growth, GDP growth, and investment growth. Informality declined in countries that basically improved governance. Informality declined in countries that improved access to credit. So, in other words, countries, they undertook certain reforms, able to, deliver higher growth at the same time, so decline in informality. Now, whether it's possible to build buffers in an environment when you have weak growth, the answer is it's very difficult. But policymakers in this environment need to basically reduce uncertainty, find ways to send a message of confidence about they have forward-looking policies in place. They don't have to necessarily, create buffers immediately, but they need to have a clear plan, which could be a medium-term fiscal plan, and show the will to implement that plan. Most of the times, governments come up with these plans, but governments are not credible, or the plans are not credible. Now, about fiscal policy and whether fiscal policy can stimulate growth, in cyclical sense, fiscal policy can stimulate growth in countries that have fiscal space. So when you do not have fiscal muscle, that means you do not have the type of debt levels that lets you to basically implement expansionary fiscal policy. You have very large debt, you have significant deficits. You can try to implement fiscal policy, but it is counterproductive. So in a nutshell, fiscal multipliers tend to be smaller in countries. They have basically smaller, weaker, smaller fiscal space. Now, this climate risk issue is very important. I increasingly get these questions when we talk about forecast. Our forecast is short term. We look at most of the time, actually, we focus on the next year, maybe the second year. And there, it's difficult for us to take into account climate risks. Increasingly, we think about, how climate risks hit vulnerable countries and think of certain scenarios. In the latest JEP, we undertook the exercise and look at this food price shocks. When a food price shock happens, it could be because of climate risk, it could be because of fragility, and the price of certain, for example, agricultural commodity increases around the world, how countries react basically in a very self-serving fashion and ending up basically hurting themselves. Everybody becomes protectionist, everybody's trying to basically protect its own market, and then of course that increases the magnitude of the shock, makes food prices even higher. What is interesting in this context, whether long-term growth forecasts take into account climate risk seriously. My sense is that, at least when I look at the consensus forecasts, they do not. Now, about the question of role of governance and informality, governance plays a very important role when we think about informality. Often, informality arises. Basically, the firms think that they are not getting the public services because they don't trust the government for one reason or another. So when you improve governance and when you have the regulatory playing field, you are able to get some gains in the context of informality. Now, finally, about inflation, it's a very good question. I'm very happy that you asked it. I invite all of you to go to the www.worldbank.org/inflation. We released a very comprehensive study. We are worried about inflation. Not necessarily we think that there is going to be much higher inflation this year or next year, because we are worried about the underlying reason that forced inflation down in emerging market developing economies since the 1970s. They have been under threat. When you look at emerging market developing economies, in the early 70s, these countries had, on average, more than 17% inflation. Now, that number is around 3%. Remarkable achievement. Why it has happened? Because of the forces of globalization, basically pushing these countries to become more productive, more competitive in terms of their markets. Second, moving basically towards more independent central banks and more credible monetary policy frameworks like inflation targeting. Now, when you think about what's going on around the world, of course, globalization has been under threat. The force of globalization has been under threat. And in some advanced economies as well as emerging market developing economies, central bank independence has been under threat. Central bank independence by itself plays a critical role, because when financial market participants do not believe that central bank can make decisions independently, they will change long-term inflation expectations. When that happens, inflation will increase. So there are, of course, cyclical reasons, and those cyclical reasons, started prior to the global financial crisis, deepened because of the global financial crisis, and in all likelihood, because of those cyclical reasons, we will continue seeing low inflation. But the underlying challenges associated with central bank and globalization, we need to pay attention, and we discuss these issues in detail in this new study. Let me stop here. Thank you.
Thank you very much, Alan. So we've run over time by 15 minutes, but I did want to make sure that you got an answer to many of the questions that had been raised. I think I'm just going to end by saying that, if you listen to all of the panelists, the common theme is that we're moving through a transition, which is going to be difficult because policies will matter more than they did in an environment of plenty of liquidity, and policy mistakes will cost you more at a time when shocks are likely to be more likely to happen. And I think the conversation we need to have next is not just what needs to be done, but what are the political economy constraints in countries that make it harder or easier to actually do the things that we think need to be done. And so I think the sort of policy recipe is fairly clear, but the ability of countries to implement those recipes varies a lot across. And will countries really only be able to make the right decisions in response to being hit by a negative shock, or can they make those decisions before so that they can mitigate the impact of a negative shock when it hits them, is going to be, I think, what distinguishes some countries from others as we go forward. So thank you all for coming, and thank the panelists for being here.
Thank you very much.